This past week in tech felt less like a stock market and more like a crime scene. CEOs are blaming intelligence tools for laying off 4,000 people. Doomsday articles are crashing entire sectors overnight. And Nvidia just reported the greatest earnings in market history, only to see its stock drop 10%. Welcome to the peak of the AI panic. Right now, everyone is terrified that AI agents are going to steal our jobs, crash the economy, and replace human coders. In this video, I'm going to show you why this fear-induced panic selling is a classic overreaction to new technology, why OpenAI CEO Sam Altman's terrible PR is giving you a massive buying opportunity, and which stock I loaded up on this week while everyone else was running for the exits. Grab a coffee, hit the like button, and let's dive into the reality check you desperately need this week. Quick disclaimer, I'm not a financial advisor. I'm just a guy on the internet with an opinion. Always do your own research before investing. All right, let's do this. Let's begin with what has Wall Street on edge. You see, AI is no longer being framed as a productivity enhancer, but as a direct replacement for human labor. About a week ago, a macro-themed Substack called Citrini Research published a triggering piece online. The post circulated heavily and gained traction on Twitter over the weekend of February 21st to 22nd and led to a huge sell-off when the market opened the following Monday. The piece is genuinely excellent storytelling, but it's almost impossible to read without feeling anxious, depressed, and nervous about the future. The article, titled The 2028 Global Intelligence Crisis, paints a stark picture of how AI will outright eliminate large segments of white-collar employment in the next 2 years. Companies targeted in the piece include DoorDash, American Express, and MasterCard. Each of those stocks dropped anywhere from 6 to 8% on Monday alone. That's a huge single-day decline from a fictional piece published on Substack. People are treating AI like an asteroid hitting the labor market, when historically we should be looking at it like the invention of the tractor. Yes, the tractor replaced manual plowmen, but it birthed entirely new agricultural industries. And let's not forget that fear scales fast, and it pays handsomely. Turns out the author had taken short positions in several names cited in the piece. Doomsday projections drive engagement while potentially strengthening those trades. While concerns in the piece may be valid, I wouldn't let dramatic storytelling override rational analysis of AI's trajectory. On that note, Citadel Securities, the largest designated market maker on the New York Stock Exchange and founded by legendary investor Ken Griffin, released a rebuttal piece reacting to Citrini. They highlighted that the increase in software hiring contradicts the panic. This aligns perfectly with my thesis that there will be 10,000 new software applications built, and that will require more humans, not less. I highly recommend you read through both pieces to get a grounded perspective. But let's be fair to the bears. Part of this panic-induced selling is grounded in very real, sudden market shocks. The reason AI stocks are facing such intense downward pressure is that every few days, a new AI product drops and completely wipes out the valuation of an entire legacy industry. Just look at what happened this week with Anthropic's new tool, Claude. They launched an AI vulnerability scanner called Claude Code Security, and it instantly sent the entire cybersecurity sector into a freefall. Stocks like CrowdStrike and Palo Alto Networks dropped anywhere from 9 to 18% in a matter of days, because this AI found hundreds of zero-day vulnerabilities that human auditors missed for decades. Then Anthropic announced Claude Code could successfully automate the modernization of COBOL, the ancient programming language that runs the global banking system. And what happened as a result? Well, IBM stock suffered its worst single-day crash in 25 years, dropping over 13% and wiping out billions in market cap. This presents a massive exercise for us as investors. We need to think deeply about whether this market reaction is valid or invalid. Is this a permanent structural decline for these companies, or is this an irrational panic that presents a generational buying opportunity? I lean toward the latter. Yes, there will be a basket of legacy companies that will go bankrupt and kaput, but there are several legacy names that will survive and become stronger with AI. Legacy tech will adapt, but right now, the market is shooting first and asking questions later. Adding fuel to this fire of fear is the fact that the leaders of these AI companies are having terrible public appearances. The tech is absolutely brilliant, but the optics are a disaster. Take OpenAI, the creator of ChatGPT, CEO Sam Altman, for example. He recently did an interview in India that went completely viral for all the wrong reasons. He was asked about the massive energy consumption required to train these massive AI models. Now, instead of a measured response about green energy or hardware efficiency, he said,
"One of the things that is always unfair in this comparison is people talk about how much energy it takes to train an AI model relative to how much it costs a human to do one inference query. But it also takes a lot of energy to train a human. It takes like 20 years of life and all of the food you eat during that time before you get smart. And not only that, it took like the very widespread evolution of the 100 billion people that have ever lived and learned not to get eaten by predators and learned how to like figure out science and whatever to produce you, and then you took whatever you took. So the fair comparison is if you ask ChatGPT a question, how much energy does it take once its model is trained to answer that question versus a human? And probably AI has already caught up on an energy efficiency basis measured that way.
The market and the public hated this. It's tone deaf, mathematically abstract, and completely lacks humanitarian empathy. When the face of the AI revolution goes on stage and essentially reduces human existence to a resource cost, it terrifies the public and alienates institutional investors. It feeds directly into the fear and panic narrative that AI leaders are out of touch, which only drives the prices of AI-related stocks down further. But if we ignore the bad PR and the Wall Street panic, what's actually happening on the ground? Well, over the last week, I was in the Bay Area for 5 days visiting friends, and I had a few interesting observations. I'll share one of them. I met up with one of my college buddies who works for one of the big tech companies in Silicon Valley. He's an engineer working on an AI tool you may or may not have used today. So I asked him how work is going and whether his daily workflow has changed with all the AI progress. Well, his answer was an emphatic yes, and that he has effectively transitioned from years and years of manual coding to now splitting the coding work among 4 agents and managing these agents on a daily basis. His answer reminds me that in the context of a company being an orchestra, a modern software engineer is no longer a solitary violinist, but rather an orchestra conductor. You don't need to play every single instrument anymore. Your job is to coordinate the AI agents, the strings, the brass, the percussion, to create a cohesive symphony of code. The output multiplies exponentially, but the human oversight, the taste, and the architectural vision remain absolutely critical. Unfortunately, not every tech CEO sees AI as a tool to empower their workforce. Some see it as a convenient PR shield for bad management. Last week, Jack Dorsey, CEO of Block, the parent company of Square and Cash App, announced on Twitter that roughly 4,000 employees would be let go, a reduction equal to about 40% of the company's total headcount. They had 10,000 people, now they're going to have 6,000. Jack blamed the cuts on intelligent tools, basically AI, but I don't think it's related to AI entirely. You see, Jack Dorsey is very similar to my first modeling agent, the one that discovered me, which led to a prosperous 14-year career as a model. That agent had a great eye. He was excellent at scouting talent and building a solid roster. All the models that started alongside me ended up doing very well in their career, but they all left after a year or so to go to another agency because the agent was not very good at managing and cultivating talent. He would routinely drop the ball on casting details, and clients would tell me they had to follow up multiple times to book me for a job. So after about 8 months of that, I moved to a more established and professional agency. The difference was night and day. Dorsey builds genuinely cool products. He's like a Steve Wozniak, but he desperately needs a Steve Jobs to move the company forward. He has a track record of hiring too many people. Look at Twitter, which he founded. Elon Musk fired 80% of Twitter's employees when he purchased it, and it's a significantly better product now. It seems that Block is in the exact same situation. AI is just the convenient excuse to correct years of bloated, undisciplined overhiring. Unfortunately, I think we're going to see a lot more layoffs like this one in software, both because of AI and because of bloated, undisciplined overhiring during COVID. While software companies are frantically figuring out their headcount and fighting off Claude code, the hardware side of the equation is literally printing money. Last Wednesday, Nvidia reported earnings, and boy, was it nutty. Let's break down a few numbers from the call because they're absolutely absurd. They posted $68 billion in quarterly revenue, beating Wall Street's estimate of $66 billion. That's up a whopping 73% year over year and up 20% from last quarter, one of the biggest sequential growth jumps in company history. For reference, $68 billion in quarterly revenue is more than what McDonald's, Starbucks, Nike, Chipotle, and Target made combined in the same quarter. The data center business generated $62.3 billion alone, up 75% year over year. For the full fiscal year 2026, $216 billion in revenue, up 65%. And the company guided Q1 revenue to $78 billion, well above Wall Street's expectations of $72 to $73 billion. And keep in mind that this is after Nvidia has beaten Wall Street revenue estimates 13 consecutive times. Absolutely nutty and so damn impressive. Now, despite crushing expectations, Nvidia stock actually dropped 10% in the 2 days following the call. The market is showing an inability to price exponential growth curves. A 10% drop on record fundamental earnings is a symptom of misaligned fear, not a weakness in the company. Because I believe this panic is absolutely invalid, I treated it as a massive buying opportunity. So I purchased a lot of Nvidia stock in the last 2 days. The truth of the market is simple. Winners keep winning. Jensen Huang isn't just a CEO. He's a generational leader steering the most important company of the 21st century. And if you think about it, this exact moment is the worst AI will ever be. It only improves, accelerates, and optimizes from here. Late last year, Nvidia acquired AI chip company Grok for $20 billion. The founder of Grok, Jonathan Ross, tweeted a few days ago that if it feels like things are moving fast, brace yourself. This is the slowest things will ever move, ever again. AI is moving at warp speed. The core concept that Jensen reiterated over and over again on the call was that compute equals revenue. He said, don't worry if companies are spending billions on our chips right now. They're not wasting money. Those chips are like factories printing money for them because more compute directly turns into more revenue for their businesses. Look at the massive capex from Amazon and Google. They're not just buying chips, they're buying the infrastructure that guarantees future cash flow. Which brings us to a fascinating question. How crucial is Nvidia to Netflix? Well, it's incredibly crucial, especially given the bombshell news that dropped this week. Netflix officially backed out of the Warner Brothers deal. Now, at first, I had mixed feelings about it. Warner Brothers has a legendary catalog, and now that catalog is going to their competitor Paramount, and Netflix has no access to that. But after sleeping on it, I actually feel great about the outcome. Netflix showed incredible financial discipline and a lack of ego in not overpaying for Paramount. By walking away, they forced Paramount to pay an exorbitant amount of money for the acquisition. Paramount's bid began at approximately $70 billion 5 months ago, and now it's a whopping $111 billion at the final winning bid. That's a $41 billion increase, a 59% increase in what they have to pay Warner Brothers. And by the way, the $111 billion figure doesn't even include the $2.8 billion breakup fee that Paramount agreed to pay Netflix on Warner Brothers' behalf. So for a few months of back and forth bidding, Netflix managed to secure $2.8 billion from one of their competitors and forced them, by way of a bidding war, to pay $41 billion more than their original offer. And as a bonus, the stock had a nice pop of 14% following the news. Paramount essentially swallowed a whale and is now drowning in an ocean of debt. And because of this, Netflix might actually be able to buy out both companies for a much better price in a few years' time, given the insane amount of debt Paramount will have to resolve. The biggest win, in my opinion, is Netflix confirmed in a press release that they'll be reinstating their share repurchasing program, which is excellent news for shareholders, especially at the current 30% depressed stock price. But here's the immediate technological ripple effect. Will Netflix require more compute now that they're not acquiring Warner Brothers' library? Absolutely. By passing on legacy libraries, Netflix has to lean entirely on generating, rendering, and serving their own massive pipeline of organic content globally. That requires monumental server capacity, which circles right back to their reliance on Nvidia's ecosystem by way of AWS. Finally, let's talk about where all this massive tech capital might flow next. The rumors are heating up, and it's sounding like the SpaceX IPO will more than likely be happening this year. It would make total sense for them to go public during the Trump administration, given the ease of regulation. If the rumors are true and SpaceX IPOs at a $1.5 to $2 trillion valuation, it's going to be the biggest market event of the decade. So, am I buying on day one? No. I won't give into the hype and buy right away. There's a concept called the private market hangover, where retail investors usually end up acting as the exit liquidity for early VCs. Most IPOs are way overpriced initially due to hype and will correct over time to a lower, more reasonable price. Trust me, I've succumbed to the hype surrounding IPOs, and it's just not worth it in the beginning. And I'm very happy with my ownership of SpaceX by way of Google stock and Tesla stock right now. I'm going to sit on my hands, watch the initial retail frenzy burn off, and look for a sane entry point once the dust settles and the stock corrects. Whew. So that's a reality check for the week. I know, it's a lot. The market is drowning in fear and panic. AI is not ending the world. And bad PR doesn't change the underlying fundamentals of generational companies. I encourage you to look past the fear-mongering headlines and follow the actual capital. Let me know what you think down in the comments. Are you buying the dip or are you staying on the sidelines? Thanks for watching, and I'll see you in the next one.